Hello and welcome to BST Live, the show for systematic and algorithmic traders. And can you believe the year is just about to end? We're about to get to a new year. I cannot believe that it's almost Christmas, but it's a very exciting time of the year because we get to reflect on the things that went well, things maybe could be done better, and we get to plan for the year ahead. And that's exactly what we're going to be talking about today. And we have three special guests. That's right, not one, not two, three special guests, which is something I don't think we've ever done it before on this show today. So I'm really excited to be sharing these guests with you. And the first one is Mr. Kevin Davey. G'day, Kevin. Welcome.
Hey, Andrew. How you doing? Glad to be here.
I'm doing really well. And you? How are you doing?
Good. Very good.
Can you believe that it's another year gone already?
Yeah, it seems
Unbelievable.
to every year seems to go faster and faster. That's for sure.
Yeah, exactly. So I know you've done some great things this year, and I can't wait to dig into those a little bit more. But first, I want to start with a question for you, which is not one that I actually planned. It's a bit of a surprise question for you.
Uh-oh.
So it's not a trick question. It's okay. It's not a trick question, but it's a good one, I think, to get started. So the question is, if you could summarize the past year in one word, what would it be? What would that word be?
Variable.
Variable. Wow, that's not a
And
word I was expecting.
there you go.
Yeah.
And what I mean by that is just it seemed like trading was up and down and up and down, and it was variable throughout the year. There were times where it seemed like everything was going right. And then there were times where it just seemed like everything was going wrong. And it never seemed to sustain itself in one direction or another, kind of around lot. So it was variable. That would be the word I'd use.
Right. Okay. So that makes a little bit more sense now, but I would like to dig into those a little bit more. The things that went really well and the things that you know, made it variable. So um, do you have any? Actually, maybe we'll start with the good stuff first. So, how about what were some of the good things that you discovered this year, either through your trading or your research, or just generally observing the markets?
A lot of it was, for me, was probably just, I think, just getting better as a strategy builder. So,
Mm,
even though I've been doing this for maybe 15 years of building strategies, it's always something to try to improve. And what it seems like, especially the last few years, it seems like there's more and more people getting interested in algo trading. Uh, and as a trader, you really have to just keep improving and keep trying to up your game. You can't just kind of rest on your laurels. And so that uh, was a big challenge, but it was also a big accomplishment because I was able to do some things differently this year as far as maybe automating some of the strategy building that I do just to make my life a little bit easier.
mm.
So there's a lot of that going on.
Yeah, right. Okay. And so, what about, was there anything, was there a particular moment that really inspired you to make those type of changes, or was it gradual over time kind of
I think it was more
situation?
gradual over time. It's
Mm,
just something, as I get more comfortable with doing what I'm doing, I'm always looking for ways to either improve it or to make it quicker, to do it faster and that kind of thing. So a lot of it kind of centered around that. Just, hey, how do I improve what I'm doing and how do I do it faster?
yeah. Why do you think it's important to be able to do it faster?
Because then you can test, do a lot more testing. So for example, maybe in the past, what used to take me a few hours to test 5 or 10 strategies, maybe now I can do 20 or 50 strategies. So I can test out a lot more ideas. And as part of that, I can also make my criteria that I'm looking for good strategies a little tougher. So
Mm,
I'm kind of forcing myself to create better strategies just because I'm making it tougher to pass strategies. So it kind of all kind of comes together to improve
Mm.
my trading.
Yeah, I think that's a really important trait for traders to have, is to always be trying to improve on things, and especially in the the algorithmic trading space, trying to make it tougher for strategies to pass all your robustness tests. I know you've got some quite advanced techniques that you teach in your strategy factory workshop. But was there anything particular in markets, like that you saw that really drove some of your improvements this year? Because I think there's a lot of opportunity when things don't go right to to improve yourself and really stress testing things. So, was there anything
Hmm.
particular in the markets that got you to that space?
Yeah, I'd say probably since probably around the beginning of September or so, where short trades in some of the stock index futures started to look a little more appealing. You probably had the whole beginning of the year where, hey, just go long kind of thing and don't worry about it.
Mm,
But starting in September, you started to see there was some opportunity on the short side. Now, of course, the problem is in building a strategy for the short side, it's just hard because there's 10 years or more of bull market, pretty much bull market. And so it's hard to get enough data to actually have good signals for when those short signals come. But
mm,
if nothing else, it just kind of enforced upon me that, hey, don't forget about those strategies for stocks and for stock indices that do go short. I mean, that's
mm.
something that's pretty important.
Yeah, yeah. So, how did you approach that issue of, the I guess the limited data because of the the market environment for so long? How do you? I mean, that's definitely a challenge. So, how did you approach that?
Well, there's a couple different ways to do it. The one is actually just to only take short trades. So I don't like creating strategies that only go long or only go short as a general rule. And in most markets, that's a pretty good way to go. But with with stock indices, you could just say, hey, I'm only going to go short and I'm going to try to develop a strategy that only goes short. And it turns out that it's really, really hard to do. But especially with the last 10, 12 years of data. But if you can do it, uh, that's a nice little thing to have in your portfolio. And so maybe it's just sitting on the sidelines for 90% of the time, but
Mm,
if the appropriate conditions come up, it'll take a short trade, and hopefully, if it was tested good and history sort of repeats itself, it might work out. So that's one way you could do it. But like I said, it's pretty tough.
yeah, yeah. I think it's interesting you mentioned short selling, because the next guest is Laurent Bernut, who is he literally wrote the book on short selling. So we're going to
Yep,
probably
I
talk
have
about
that
that
book.
soon. Yeah, yeah, yeah. But so you said you noticed in I think it was September that there was opportunities for shorts. But did you ever think about um, what could be coming in the future? Potentially there's a bear market coming because we've been going bullish for so long. Do you ever think about what could come? Should I start preparing for that type of thing as well?
Um, Not really, because if you really think about it, people have been predicting a bear market for a few years now, easily. They've said, hey, this bull market won't last forever. And it just keeps going. And even in 2020 with COVID, when it looked like the world was going to end, all of a sudden the market took off and the bull market continued. So, the one thing I try to do, though, is to make sure that I'm not over leveraged and I'm not over focused in any one sector. So, for example, with stock indices, yeah, I have my active trading, which is mainly futures, and it's a broad variety of futures. But I also know in the back of my head that I have retirement money that's mainly in stocks and ETFs, and it's mainly long the stock market, which, most people are. So what I try to do there is make sure my active stock index trading that, hey, if all those were long and I'm long in retirement money, that it doesn't completely overwhelm me. So I try to kind of scale back a little bit. And that's my approach to not knowing the future and saying, hey, if we do have a bear market, I won't be totally destroyed. And I'll have all these other sectors to work with.
Yeah, we got a good question in the chat here from Lisa. It's much more difficult building short side strategies as being such a bull market. So agree with Lisa there. I think, Lisa, actually, you may be the very first female comment on this show. So there you go. It's finally happened.
There you
Very
go.
male-dominated industry, I think. So
Yes.
thanks for your question, for your comment, Lisa. So, so Kevin, I wanted to ask you about the World Cup. What's it called? World Cup Trading Championship. Because I
Yes.
know you entered this year, and I'm sure you got
I was
some
doing
great
good for a while.
you got some great insights from that. So, what can you tell us about that journey?
Well, just to recap, so I'll just lay it all out there. I was
Sure.
doing real well for a while, just chugging along most of the year. And I actually got into, I think, as high as third place, third, fourth, fifth place, mainly fourth and fifth. And then this was a strategy that was, at the time, it was primarily the mini NASDAQ or the micro mini. And it was primarily long. So when the market came down, I kind of got hurt and kind of bounced around. Then I was coming back, and I thought I was in actually a good place up until the day after US Thanksgiving. And that was when the Omicron variant was first discovered. And that day, all the stock markets took a dive, and what was worse was crude oil took a dive, and I was long crude oil, which was a new system I had added on because I said, hey, if I want to break the top five, I've got to add a little more juice to this. So I decided to roll out a crude oil strategy. And of course, it went long, a couple days before. And
Yeah.
so, long
Let
story
me start
short, I won't
again.
be finishing in the top five.
Mm,
But it's the important thing for me in trading a contest is you have a certain goal. And the goal for me was, I said, if I get around 150% return over the course of a year, I should finish in the top five. That was what I was aiming for. And if you look at the standings now, I believe that still holds true. Around 150% would get
mm,
you in there. And so when you're going for those kind of gains, you're taking some big chances, almost by definition. You're not just doing these little trades here or there and, slow and steady. You're kind of going for taking a lot of risk on.
yeah.
And sometimes it works, sometimes it doesn't. And unfortunately, this year it was working for a while. And actually, I wasn't taking huge chances, but it worked pretty well. And then I started to amp it up, and that's what kind of caught me. So, um, good lessons there as
Yeah.
far as having objectives of what you want to do, and then just being prepared to work that plan. And if the plan doesn't work, it doesn't necessarily mean it was a bad plan. It just sometimes you don't get that luck factor that works in your favor. And that's kind of the way I look at it.
Yeah, I remember we spoke many years ago. Actually, I think it was probably the first time you and I spoke on the show, and you were talking about the role of luck. And I remember you saying that it used to be like 100% return would get you at the top, and now it's like 150. Do you think that's what's driving that? Is that like the markets are more volatile, or do you think traders are getting better with their strategies?
I don't know. And yeah, you're right. Way back when, this is what, 15 years ago, I was aiming for 100%. This year, I thought 150. And it was really just looking at the previous year, couple of years of what their performance was. What's interesting is if you look at the Forex contest, which started the same time, all those top five, I think, are over 200% or
Mm,
around there. So, which I really found interesting. I was like, why are the Forex people higher? But it might be uh, traders have gotten better, or it might also be just some increased volatility, especially this past year and a couple of
mm,
years with COVID. Things have been bouncing around a little bit more.
yeah.
But yeah, I don't know if I'm going to do it next year, but if I do, I'd probably end up going for that, like around 150%. I think that's uh, reasonable for finishing well.
Yeah. Okay, we got a couple of good questions here in the chat, Kevin. So let's do
Okay.
this first one from AW. How do you avoid switching or redoing strategies due to improving your personal development process? It can feel like I'm jumping around and not letting anything play out properly.
Well, that's one thing I don't do. I will add new strategies, but I won't necessarily turn off existing strategies. So I kind of let the existing ones still work until they either break or they just stop working well. Maybe they just go to break even. And that's what usually happens more than not for my strategies. Is it's not like they fall apart and just start losing money like crazy. It's
Mm,
more like they'll just kind of go flat. But I look at, as I build new strategies, I realize that new strategies haven't had years of real time data like some of the older strategies
yeah.
have. And so that kind of factors in too, because every back test you run, you're going to get some slightly optimistic results as a whole. So if you have 10 great looking back tests, you're not going to have 10 systems that work great going into the future. They're going to degrade, and so
Yeah.
you've got to take that into account, which I think a lot of people just see a back test and think, oh, I'll just keep trading that, and that's not really the way it works. So in my own trading, what I try to do is to make sure that that's kind of accounted for, that I don't just look to the new bright shiny thing just because it looks better. I realize, well, hey, it hasn't proven itself. uh, you got to give it some time to prove itself compared to some of the older strategies.
Yeah, it's very tempting to do that, isn't
Yeah.
it? Okay, thanks for that, Kevin. We've got a couple more questions here in the chat. Um, let's go to Rubicon. Thanks for the question, Rubicon. If you're trading a very liquid market like E-mini and micros, what sort of time frame would you go down to for short-term trading strategies? Does the time frame matter in terms of profit factor?
Well, I go down as low as like 1 minute. I won't go below that. I don't do tick charts because I just don't have the historical data. Most trading software will give you like 6 months, and you can't do an adequate back test on that. But the problem with those short time frames is there's a lot of noise in the data typically. There's a lot of back and forth. If you look at 1 minute bars, you'll see a lot of bouncing around, and trends tend to be really short, and that makes it tough. Especially when you have to consider that you have to overcome slippage and commissions on your trades, and what it kind of leads you to do. And every time I've tested it, it's come out the same way, that the bigger the bar size, the better off and the easier it is to create strategies. And that could be a combination of less noise in the bars, so you have more signal, if you want to call it that. You have more trends, and that those trends are bigger relative to your trading costs. A good example is for somebody who has like a 1 minute system that trades 10 times a day. If you're using market orders in ES, you pretty much have to make about $150 a day just to break even, just to overcome those fixed costs, where maybe there's somebody else who says, hey, I'm only going to take one trade a day. Well, his cost is around $15, around, with slippage and commission. So he has a lot less to overcome. He doesn't need as big of a trend as somebody who's rapidly in and out. So the end effect is, I find most of my strategies are bigger bar sizes, up to like daily.
Yeah. Okay. Thanks for that question, Rubicon, and thanks for the question, the answer, Kevin. Rubicon said, "I'm the guy on Twitter who asked you about your dedication in your book."
Okay.
That's who Rubicon is.
Yeah, and yes, he had copied Laurent on that. So
Okay. Yeah. All right. Well, how about one more question, and then I want to ask you what you're preparing, or what are you doing to prepare for next year? But we've got time
okay.
for one more question. So here's another question from AW. If you find an S&P strategy with a meh long side but awesome short side, would you still trade the long side just in case? And if you would, then why?
Okay, I'll turn that question around. Let's say instead of just a meh long side, it was a great long side. Would you have asked that question? And the answer is no. You would have said it's a great long side and great short side, so I'll trade it. So since you asked the question, it was because it was a bad result. And now you're going to be making a decision based on knowing the result. And that's almost always a bad thing to do.
Mm.
If you had said up front, hey, I'm just going to do the short side, that's it, hey, that'd be fine. But no, you tested the long side and you said, well, maybe I'll use it. And then it turns out to be bad. And now you just throw it away because you don't like it. That is just optimizing. You had two choices there and you picked the better one. And I think that's, sooner or later, that's going to get you into big trouble. You can't do that kind of thing. A good example is a system that you run, and then it looks good, and then you say, well, what about Mondays, Tuesdays, Wednesdays, Thursdays, and Fridays? What day does it look good? And you find out that Thursdays are terrible. So then you say, oh, I'm throwing out Thursdays, and you draw a new equity curve without Thursdays. It looks great, and you say, oh, I'm there. Same kind of thing. That's a terrible thing to do. Where the flip side is, if you had said, I'm going to build a system and I'm not going to trade Thursdays because of some reason that you have, and then you go and test it and it looks great without Thursdays, that would be okay. So, and people are probably scratching their heads a little bit like, I don't see the difference. You're still not trading Thursdays. But it's how you arrived at the answer. That's key.
Yep.
So yeah, I would. If you can't trade the long side and the short side, I wouldn't personally trade that.
Yep. All right. Thanks for that answer, Kevin. So we've got a couple minutes here left. So I'd like to ask you now, what are you doing to prepare for the year ahead? How are you getting ready for it?
Well, one thing I always do at the beginning of the year is sort of an abbreviated sort of trading plan. And I actually, for people who are on my email list, they'll be notified I do a webinar almost every year on just trading for the next year, things to think about, things to review in the previous year, which would obviously be this year, 2021. And the whole goal is to look at your trading and figure out, well, what could you do differently? Maybe you need more strategies. Maybe you need them in different markets. Maybe your risk was too high. There's a lot of different things you can look at, but to get better, you've really got to look at your previous results and say, maybe this wasn't the best thing to do. So I'm not going to do that next year. I'm going to do something different. So that's the first thing. And I usually do that like in early January, and that kind of gets me off to a good start. The other things I'm doing, always building new strategies. And so, for example, I'm running pretty much almost 24/7 testing on another computer just to build new strategies. And so I'll probably roll out some of those in the beginning of the year. And beyond even just the strategies is just look at all aspects of my trading. Do I feel like I'm doing things right? For example, with automation, or do I have a lot of mistakes or a lot of errors? Are there things I need to correct? So it's really just, you've got to take a really hard look at what you're doing and just be honest with yourself and say, it's just not going as well as I want it to be going. I got to make some changes. And for me, until I get to the day, until I don't have any drawdowns, which will never happen, I'm always going to have something that I think I can improve. And that's what I look to do every year. Just, hey, how can I get better? Because I'll tell you, compared to 10 or 15 years ago, algo trading is definitely tougher. The tools are better for everybody. Everybody can do back tests now. The good part about that is probably 90% of people do back testing correctly. So there's still that, but people are learning. Where 10, 15 years ago, very few people did back tests, at least did them well. So it's just a constant improvement. That's like the big thing I'm preparing for next year, and that I prepare for every year, to be honest.
Yeah, that's a great way to end up our segment today, Kevin. So thank you very much for that. So how can people get in touch with you or learn more from you? Where can they go?
Sure. They can just visit my website, kjtradingsystems.com. And you can sign up for a free algo I give away and just get on my mailing list, and then you'll be notified of webinars and that kind of stuff. Sometime in the beginning of January, I'm going to be doing like a week-long bunch of video releases and a couple live webinars, like a whole bunch of stuff all together. So if you want to get some of that information, just be on my list, and then you'll be notified.
It sounds like you're going to be starting the new year strong.
Yeah, hopefully.
Excellent. All right. Well, thank you very much for your time today, Kevin. Half an hour goes so quick, doesn't it? Feels like we just started, and we got another guest coming on in a minute. So how about we've got 1 minute, Kevin? Any closing words for traders to wrap up our chat today?
Okay. The big thing I'd say is trading is tough, and don't let Twitter or StockTwits or Discord or anybody out there tell you it's easy, because there's a lot of people who claim it's easy, and then when you pull back the curtain on them, it turns out they're not really trading. Trading is hard. So, and when you start to think it's easy is usually right before you get walloped. And so my advice to everybody is just have that mindset of, hey, this is a tough game. I've really got to work hard to compete and win at it. And, you should be a lot better off then.
Yeah. All right. Excellent. Well, thanks a lot for your time today, Kevin. Really do appreciate you sharing some of your insights and your plans for next year. So I wish you all the best. I wish you a Merry Christmas, and hopefully we get to chat again in the new year.
Yeah. All right. Well, thanks, Andrew. Same to you. And good luck with the rest of this show.
Thank you very much. All the best. Now, don't leave just yet, because we've got another guest. That was the first guest, Kevin Davey. Fantastic chat. And our new guest coming on is a short seller. Boo. No, maybe not. Maybe not. It's Laurent Bernut, who actually literally did write the book on short selling. Welcome. Elvis is alive.
Oh dear, it's still there. Oh dear. Oh dear. We didn't change that one. Oh dear.
Oh dear. It's okay. We can change your name later. No problem. So, Laurent, I understand you're coming to us from the base of Mount Fuji.
That's right.
Sounds exciting. Yeah.
That's right.
What
Yeah.
are you doing there?
We're on holiday with the family, and they're going on a safari. So this is why we changed the schedule, because my wife is going to feed me to the lions, to the great delight of all the customers. I'm going to the safari after that.
Well, I'm happy to be doing your 5 interview. So thank you very much, Lauren.
Absolutely. Hey, a big shout out to Kevin Davey. I'm a huge fan of your work, sir. I really like your work. I really like your personality and the personality that you bring to trading. Like, trading is the toughest way to make easy money. It resonated with me. It's still there. I really like your style, sir. I'm a big fan.
Yep.
It's an honor to be sandwiched between illustrious guests like that.
So, Laurent, we're going to dig into your year and some insights you've got. And I'm going to ask you about the bear because I'm sure there's a reason for that guy. You do everything for a reason. So I'm going to ask you about that. But how about we start first? My very first question. My very first question to Kevin, I'm going to ask you too to see what you come up with. If you could summarize the past year into one word, what would that word be?
Legless.
Legless.
She's got legs. She doesn't know how to use it.
Legless sounds like all the years in my 20s.
Wow.
Oh dear. All right, legless. So why do you say legless? Why did you pick that word?
Actually, it's interesting because the beginning of the year was it started strong all the way up until January. Then it gave a lot back, and then it was making it all back. And there were lots of breakouts, lots of false breakouts. Stuff that looks like it's moving, and not again, not really, not there yet. So it was interesting. So there was a lot of distribution, a lot of rotation. It was interesting. I mean, I learned a lot. I learned the limitations of my system, particularly. So, like last year was fairly easy money. I mean, last year was very easy. You knew that at one point. I mean, I bought this market in March 27, 2020, and on April 8th, and I knew that it would be a one-way ticket all the way. I mean, it's not really complicated. Back in 2018 or 19, I wrote a post on Quora saying that. Because we have this lingering fear about the market, right? Oh, when is the next bear market coming? When is the next bear market coming? As soon as the market drops 2%, bear market, no. And then, and my thinking is like, it's not very rocket surgery there. I mean, the monetary cavalry is going to step in. So you don't have to worry about the next bear market. You have to worry about the bear market after that. The reason being that the next bear market, they're going to burn the furniture. Wow. So, for instance, here I'm at the basis of Mount Fuji, and there's Disneyland called Oriental Land in Tokyo. The share price of Disneyland Oriental Land went higher during the lockdown when the thing was closed than it was when it was open. That tells you something, right? For the fixed cost business, share price goes higher. So, they burn the furniture. So once they burn the furniture, then obviously it's going to be very difficult to heat up the building. So this is the bear market that comes after that we have to worry about. So I knew that back last year that it was easy to buy, and now they kept on putting everything in the furniture. Like, okay, let's masterpiece painting. Yeah, throw that in. Why not?
Yeah. So let's talk a little bit more about your insights from the year that just has gone. You've just shared a little glimpse into it there, but what have you really discovered about yourselves, your market? The market strategies, etc., over the past year?
Now that's interesting because 90% of trading is mental. The other half is solid math. Right?
Yeah.
So the idea there is now I trust my system.
Yeah.
So now I'm in there's a good inner alignment between yours truly and the system. Like I don't panic when I'm in drawdown. I'm in drawdown now. Do I look panicked? Not really. No, right? So I'm not exactly panicked. At the end, I mean, halfway through the year, I journal. So I journal when there's something happening. I journal, but I journal in a strict format. So what really came out, the two objectives that I would have about yours truly, this is not going to be nice, lazy and not humble. Well, that sums pretty much my life. We can close up the interview with that. But lazy, as in I use a scale-out system. Being a short seller, the idea when you're a short seller is that, and as Kevin said, that we don't have much data about it. But when the market tanks, whenever I feel intelligent, I know there's a bear market right around the corner. Like for a short seller, when you go out and sell short, for a lot of people, it's a buy opportunity. They want to buy on weakness. So you're going to have to face the crowd. So the idea is like, you take the first order of business when you enter is reduce risk and continue as a free carry. So the lazy part was I realized that actually, and this really hit me on the long side, is I did one scale out. So at 1.5 R, what R is like the distance between cost and stop loss, as in Van Tharp. At 1.5 R, I used to close 2/3 of the position, but I realized it's not a proper way to do it. That's the lazy part. What I should do is close 1/3, and then close another 50% as a swing low or swing high, depending on which side I'm trading. So, and then it would naturally work out the gain expectancy. So the sequence, the series of the array of the gain expectancy would work very well. What I did though is I closed 2/3, and then because it's a volatile sideways, oh, it's working, oh, it's working, oh, it's not working, oh, it's working, oh, it's not working, and so on and so forth. So I was trading water for no particular reason. Meanwhile, the equity curve was slowly inching up, so it's not pretty. And not humble is because I believe that the market doesn't know my name, neither does it knows yours. But we definitely need to know. So, it's like a bully. The bully doesn't need to care about you, but you definitely need to care about the bully.
Fair enough. Oh, go on. Sorry, were you going to say something? Or I wanted to ask you a bit more about the scale out, but I think you maybe...
Please, by all means.
Was there something particular in the market that made you come to that realization, like a particular behavior? Because you trade the Forex markets, right? So
I trade ETFs. Forex, right. I don't trade much Forex anymore. I'm going to redo the Forex because now I use mostly Python. So I'm going to redo the Forex. But yeah, back in September, precisely in September, like I went September and October, I went long a whole bunch of stuff, and I clocked like 8R, 9R. That's beautiful. Like I really, nice. For some reason, I mean, it's beginner's luck. I mean, beginner's luck or something like this. I mean, and then I clocked them, and then I gave them back because I clocked my 1.5R, and then it goes all the way up instead of taking money when it was there. And I saw it, and I thought, okay, I'm going to trust the system. I'm going to trust the system. I'm going to trust the system. Talk, boom, taken out. So what happened is I just clocked a 1.5R or like 2R, like ridiculous, where I could have clocked a lot more. So this is when I realized, okay, this system doesn't work well for sideways volatile, where I could juice up the returns. My system definitely does. I mean, it tends to work. There are basically three types of market. There's bull, bear, and somewhere in between there's sideways. And within the sideways, is it volatile or is it quiet? Like this is the Van Tharp kind of definition. And I realized that my system doesn't work for that. So that's it. Also, another thing that I realized is I have this convex thing. So I calculate the expectancy based on the P&L of R. And I use dissociated equity curves for everybody. And what I realized is, okay, instead of using a standard duration, trading ETFs is by definition trading in the absolute series. If I traded stocks, I would trade the relative series versus the benchmark. But trading the ETFs is using the absolute series. And what I realized is actually all the way up until, I would say, September, I had a lot of longs and I had very few shorts. And I realized, okay, if I use a standard duration, the standard number of trades to calculate my expectancy, then it would be a very awkward equity curve. So what I've started to doing is using 2/3 of the open position. Like for instance, let's say I have 10 longs open, then I would look at the 30 trades. So that would be 10 close, 20 open. Calculate the P&L using the P&L on R, and then calculate the expectancy. And on top of that, slap the convex, and there we go, baby. Damn,
slap the convex, eh? Oh dear. Now I have to ask you something before I forget, because you did something this year that you've been promising for years and years, and you finally did it.
Yes.
And that is you literally wrote the book on short selling.
Thank you.
So well done. Congratulations.
Thank you very much.
It's been a long time coming, and I actually have the book on Kindle, and I was going to prove it by showing my iPad, but it was flat, so it's out in the living room charging. Do you have a book there? There it is. Look at that. Algorithmic Short Selling with Python. So, yeah, why did you write it? I mean, it's obvious what it's about because it says in the title, but why? Yeah.
Well, so I mean, the idea is very simple. The premise is very simple. So when I worked 8 years at Fidelity. Before that, I was into hedge funds, and at Fidelity, my mandate was relative short seller. So imagine, like, I'm a quantitative dude. I'm a short seller in the house of fundamental bottom up long only. And not only that, I have to do worse than the worst bear markets on record. So the day after the apocalypse, I'm going to look for a stash of Bordeaux and Côte d'Iron, because the cockroaches and the Scorpios, they're not good for conversation. I can survive pretty much anything. So, but the idea the premise of the idea is, if we were to stack all the books about buy, long, what to buy, how to buy, when to buy, blah, 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 trips to the moon would be a sad ecological reality. You don't need SpaceX, you just go on top of them and then you go to the moon. But if we were to actually gather around the literature about short selling, like on the dinner table, there would still be room for a Margaret River and
Nice,
2 glasses.
good choice.
See. So, and also what I've realized is that most of the books about short selling, they come from a long-only perspective. So it's like writing a vegetarian cookbook in a steakhouse. Doesn't really work, right? So, and the idea is 90% of the people on markets lose money, right? 90%, give or take, 80% of the professional fund managers. Out of them, fewer than half engage in short selling. So that's really stacking the odds against. So the way the book is written is by definition meant to be different. So part one is very much about demystifying the craft. And for instance, I mean, they're like, there's one chapter about like 10 myths about short selling.
Yeah.
One of them is like, it's like infinite risk and so on and so forth. Well, you know what? All fund managers or professional fund managers, they want to pass down their names to posterity. And if you watch your short go up 2-3 times against you, you deserve to have your name on a plaque at the bottom of a public urinal.
Wasn't expecting you to go there.
But also the industry is very poorly organized to meet the needs of short sellers. Like, again, I think it's chapter 2 or 3 in the book, where like all the financial analysts, I used to be one, they're all like the guardians of the financial galaxy. Specifically, they're Groot. It's a buy.
Yeah.
So they're not organized to actually find short selling. And to their credit, I mean, when the whole industry is based on buying more, it's very difficult. So how to do it? And part 2 is about like building a gain expectancy, building a robust gain expectancy. And that's really so this is where also the book, it's written with Python, but it could be it was originally written without the code. And I put the code in there to give people the opportunity to practice. This is the theory. This is the practice. Knock yourselves out. And so part 2 is really much about improving the gain expectancy. And part 3 is about building a long-short portfolio altogether. That's it.
Right. Yeah. Okay. So I find it interesting, the timing of the book. You know, we've been in a roaring bull market for a while now, and people probably ask you, it's probably a popular question, when is the next bull market? When's the next bear market going to happen? So, you know, with the release of this book, do you know something we don't know? Or is it perhaps you do?
I do. I can tell you precisely when the next bear market is going to happen. Ready?
I'm ready. Let me get my notepad. Okay.
Drum rolls, please. 9:15.
9:15. What's the time in Japan right now? Is it 9:15?
It's 11:15. Too late.
Oh, okay. So you missed it.
Doesn't matter.
Right.
I mean, I'm not in the business of prediction. I'm not in the business of forecast. But I don't know when it's going to happen. But what is probably going to happen, so the idea is, don't worry about the next bear market, worry about the bear market thereafter. And then I realized, okay, not all the monetary cavalry has been printing money forever. They've fallen asleep on the button. And what would make them stop? What would stop this bull market? Number one is one day they're going to wake up, oh, valuations are a bit frothy, don't you think? Yeah? Sugar with your tea? It's not going to happen, really. Scenario number two, the bond vigilantes. Really, Larry Summers, you really think it's going to show up? Yeah, baby. Let's stop that one. Yeah, not going to happen either. Scenario number three, inflation. Well, basically when the Fed, actually when the citizenry is angry about inflation, then it reverberates on the politicians, which in turn breathe down the neck of the central the monetary cavalry. It's probably the logical flow. And in which case, like, well, inflation, don't worry about it. It's just temporary. You know what? It's like hairpiece. It's temporary until it's permanent.
A hairpiece or an earpiece?
Go on, like hairpiece or chlamydia, whatever that is. Like, oops. Really?
Oh dear, there's a lot of firsts on the show today. We've never talked about chlamydia before, so hopefully the only time.
Hopefully so too.
So
yes,
I want to
please.
ask you though, because I think this question is probably going to lead to that. There's someone behind you there. Being so focused on short selling, are you like a perma bear? Are you always looking for bear markets? What's your philosophy?
Actually, it's a very interesting question. I believe in symmetry. So I believe that actually symmetry. Right. So for instance, a lot of people who come from the long side, they believe they should have one set of strategy for the long side and one set of strategy for the short side. Now, what happens very often is that, especially in difficult market when you're in drawdowns, your short side strategy starts to work. Meanwhile, there's a conflict on the same tickers, on the same securities between the long and the short. And then there's overcomplicated like risk management and so on and so forth. So it's difficult. My belief is I develop strategies on the short side, and then if they survive on the short side, they tend to survive on the long side. That's more or less my belief. Do I capture everything? No, I don't. Do I capture all the markets? No, I don't. Do I capture all the time frames? Probably not. I don't have the programming capacity to do that to start with. So I believe in symmetry. I believe that actually but understand the starting point is different. I start from the short side, and it's like they said in The Martian. It's space. The environment doesn't cooperate. So if you survive on the short side, more likely than not, it will be okay on the long side. Whereas if you do something that works on the long side, it's not necessarily guaranteed that it will be work on the short side. So the starting point being different, it's probably the outcome is going to be different. And am I a perma bear? No, I'm indifferent.
Indifferent, okay.
So I let the market do the heavy lifting. And I believe that actually it's not one day you wake up and there's a bear market and then one day you wake up there's a bull market. It's a long sequence of degradation. It's a long sequence of capitulation and so on and so forth.
Yeah. Okay. All right. Well, thanks for explaining that, Laurent. Now we've got some questions in the chat, so maybe we'll do a few questions and then we can start wrapping up. So there's a comment here from Richard. Richard is from Norgate Data, who do great data for if you've got Amy Broker, so go check them out. Richard said, wasn't aware of your new book, just purchased it from Pact. Look forward to reading it over this holiday break.
Richard, if you write a review, I'll send an email. If you write a review on Amazon, books live and die by the reviews left on Amazon. If you write a review, I'll send you a bunch of Jupyter notebooks that are not in the book. So please write a review, send me an email, or send Andrew an email. We'll forward it.
Yep. Okay. So thanks, Richard. So here's a question from David. Let's have a look at this one. Excuse me. David would like to know, which backtesting platform would you recommend with Python? With Zipline no longer supported, there aren't many portfolio level backtesters on Python available.
That's a very good question. That's a fantastic question. So personally, I write all the stuff that I do on Jupyter Notebook. Then I use Spider. So I do it myself. Originally, I used Wealth Lab Developer, but now since I do most of the stuff in Python, so I do it myself. But it's the one I would recommend is one coming up is called TraderLogix. That's really good. Also. There's a TradeView because I use a very simple one with Scratch. So TraderLogix is good. TradeView is good. Blue Shift with Quantra quantity is good as well. It's for non-developers, so that's pretty good. Apart from that, I don't know, to be honest.
Okay. All right. Thanks for answering that. And David, do you have a copy of Laurent's book? If not, you should go check it out. Definitely worth a read. We've got a question here from Rubicon. I think this might lead into a little bit of you talking about that there's a long sequence of events from bull to bear. So I'm interested to hear what you say about this one. There's the bear. Question: many high flyers of the year like UPST got cut to half in November onwards. What does that tell you? Is that some kind of indication?
What is UPST?
I don't know. I assume it's a stock, isn't it?
Okay, so high flyers. There's one thing that by experience I know is that moving from bull to bear, like when the market transitions from bull to bear, there's an interesting, like the leaders on the way up, the final leaders on the way up, usually the first charge on the way down. So they tend to give back a lot of stuff. For instance, to give you an example, like at the moment, I'm selling short like social media, whatever ETF. And all these guys were like racing up to the moon. My wife works at Twitter. She's delighted with the fact that I short the shit out of the universe. Come on, baby. Oh dear.
That's not your wife, is it? The teddy bear?
No.
Was that the end of the question? I forgot what we were talking about, so I got distracted. Oh, so Rubicon said UPST is upstart. They went from 40 to 400 in a year.
That's going to give back at least half of it. So what? I mean, okay. You know, at the moment, like there's a whole bunch of stuff like NFT, like everything goes up at the moment. Like my friend is into watches, his portfolio of watches quadrupled in a year.
Wow,
quadruple, like, and these are just standard watches. So yeah, there's free money sloshing around. There's obviously going to give a lot of it back. Been there, done that.
Yeah. Okay, so we'll leave the questions for now because I want to ask you, what are you doing now to prepare for the year ahead?
All right. That's a very good question. So there's something I've been procrastinating for a while. That's my third middle name. So the idea as a small project is, you know, every strategy, I mean, people try to reinvent the wheel. Like when I read strategies, when I read the code of strategies, people reinvent the wheel each time. So it's the same story all over again and so on and so forth. What I believe would be more interesting is to have I'm going to write a bunch of class of a trading sequence. So how does it look like? There's a setup, there's a first entry, then there's a position sizing, then there's a scale out. If not, there may or may not be a scale out, then there's a scale in, loop, and so on and so forth, and then final exit, reversal, and back again. See, so writing a class like this, so it's basically like building the chassis for a car. What happens at the moment is every time people come up with a strategy, they try to build a new car from the ground up. But if you have the chassis and if you have pretty much everything, all you need to do is, okay, I'm going to put a different engine, I'm going to put some different leather on the seat, I'm going to put some different color, key holder, very, very nice, lovely. And every time it's much easier for the developing sequence and it's much easier to track and backtest. So that's the first project I want to do. Also, I want to be more involved into like trading multiple time frame. So that's also something that I've been procrastinating because it's not really easy. When I say trading multiple time frames, what I mean actually is trading the same strategy with the same parameters on two different time frames. So essentially, that the asset class I would be trading would be time. Make sense?
Right.
And that's. I'm sorry.
Clear as mud.
Absolutely. Come on.
So that was, I think that was that number 2? Did you have a third one?
And numero 3 is expand my asset class. At the moment, I'm working with a friend, and I'm going to finally start to trade Bitcoin algorithmically. So, and I'm working with actually several different groups, and it's very, very exciting. Very exciting. I mean, I'm humbled each time to work with people who are smarter than me. I mean, even this guy is smarter than me, so it's not very difficult. The bar is low.
But he's not as good looking, is he? So you can't have everything.
Come on here.
So when you look at trading crypto, are you just going to look at the short side?
No. I mean, for me, like long, short, bull, bear tastes like chicken.
Doesn't matter, right?
It doesn't matter. It's all the same. Yeah. I mean, volatility is different. The beta spread is wider. I mean, the microstructure is different, but at the end of the day, it's pretty much the same. And you were talking about, like, for instance, easy money. I mean, I met a dude, like, the guy became a crypto millionaire, and I asked him, so what's your position sizing? What's your stop loss? And he look, what's my stop? What? The importance of luck in trading.
Yeah, he'll figure it out one day.
Yeah,
we all have to go through those lessons, don't we? Yeah. Okay, so Laurent, there's other questions in the chat. We're not going to get time to get to all of them. So how can people contact you with their questions if they've got?
I'm active on LinkedIn. I'm active on LinkedIn. I'm less active now, but I used to be active on Quora. I will resuscitate Quora. So LinkedIn and Quora is probably the easiest way to find me. Yeah. Otherwise, through you, if they send you an email and you forward it, more than happy to reply.
Okay.
And
that sounds.
And what's
good.
your outlook for the year, Andrew? What are your resolutions for the next year?
My resolutions?
Yeah, I mean, market-wise.
Survive. How about that for a word? Survive. I know. I think we've had a pretty good run for a while, and the gravy train is not going to go forever. So, knock on wood. Was that a knock on wood? I better let you go. You got a delivery.
Yeah, I do. I do.
Thank you very much for your time today, Laurent. Really do appreciate it, and all the best. Take care. Have a happy New Year.
Bye-bye. Merry Christmas. Merry Christmas. Bye-bye.
Now, don't move on. Don't leave just yet, because we've got another guest. That one's going to be hard to top, but this guy is even more good-looking than Lawrence Bear. Welcome, Scott Welsh. Can't believe I said that. You definitely are better looking than a bear.
I'm better looking than a bear. I'll take it.
That was a cute bear, man. That's a tough gig.
Pretty good. Yeah. I felt kind of bad, like I don't have enough props. So yeah.
You got a good hat though. What does the hat say?
It's the paw.
What is that?
Yeah, we started this last time we were together, so I can't end it now. I have to wear a hat of some sort of secret story behind it. So
yes, exactly. I'm just updating your name so people know who you are. Did I type that? Yeah, you got that right. So welcome. Welcome, Scott. Glad to have you here today. You caught the last end of that chat with Laurent, but you didn't hear my first question to Laurent. So I've got a question to get this started for today.
Okay.
By the way, Scott is I should have done an intro, shouldn't I? We just went straight into it. I didn't even introduce you.
Who cares?
Yeah, Scott, Forex trading expert, came second. Was it second in last year's World Cup trading championship for Forex at 74%? Was it 74?
Yeah, 74. Yeah.
That's not too shabby. Pretty good. You know what you're doing. All right. So let's get to the question now. Apologies for that dud intro, but I know it's going to get better from here. Fingers crossed. If you could summarize the year into one word, what would that word be? What would it be?
Summarize 2021. I want to say much has happened, and the way the year started is
right. Okay. You're not going to believe this, but your internet was cutting out for me as you explained that, and I think I heard the word annoying in there. Was it annoying? Was that your word? Yeah, the audio is breaking up for David as well. Okay, so it's not just me. I think that's a pretty good indication of the year, right? Cutting in and out, just like our internet. So yeah, can't really hear Scott. It seems like you got a and we lost him. So hopefully he's gonna get that sorted. Oh no, he's back, just like that. Let me just put him back on the screen. There he is. We might have some internet.
Right. Yeah, internet was fine here, unless, I don't know, might be translating over to Australia.
Yeah.
Melbourne doesn't like my internet, apparently.
So annoying? Was that your internet's great now? So yeah.
Annoying, but I settled on fascinating. I'm gonna go with fascinating because there's the beginning of the year and the end of the year were so totally different.
Yeah.
You could call it annoying, but I'm gonna say fascinating.
Fascinating. Now we're going to dig into why you use the word fascinating, because you've prepared some slides for us. As usual, you've over-delivered, which is great. So I'm gonna put them up on the screen and let's go through and see why you call it fascinating. And then I want to raise something with you a bit later as well, a big achievement for you this year. So let me just get the I should have prepared this earlier, shouldn't I? Share my screen and then, okay, here we go. I like the title, Beating the Market.
I hate the market. I hate index funds. We talked about that already. So yeah, that's why I named it that. I don't like index funds.
So let's jump ahead a little bit. This is the standard disclaimer we all believe in. Right, so here we go. 2021 was rough.
Well, it's funny because if you look at the market, it's like, hey, it's a bull market. And if you look at some performances, they're just outstanding. I think someone in your last talks talked about going from 40 to 400.
Yeah.
It's weird that there are a lot of great performances, but there's also it's been really, really hard for some traders. And I've spoken to them personally. Talked about, man, the last few months, 3 or 4 months have just been awful. And if you look around a little bit, honestly, it's been true. There's been a real change, as I mentioned at the top, in the last 4 months. And it's been rough. I use this as an example, the slide that we're looking at. There's a site called 40 in, 20 out. That's awesome, 40in20out.com. It's an academic research product started years ago. And they simulate actual trades in the actual markets using a pure trend following system. So it's pure trend following. You get in on a break and you get out on a trailing stop. I mean, it is pure. No stops, no bells, no whistles, no targets, nothing. So what does that mean? It will do so well when there are trends, and it will do so badly when there's not.
Right.
Or when trends start one way and then go back the other way and start one way and go back the other way. The chop is just is horrible for trend followers. It's not great for most people, but it's especially horrible for trend followers. And I just put these screenshots up earlier in the year. This particular academic study, although they do a survey, so you can follow the trades, but last year was outrageous in 2020. I mean, they did 50, 60% on a basic futures trend following strategy. I mean, they just killed it. And then earlier this year, they were up, just killing it again. They're up around 34%. And this was back in May. Like January, February through May was so easy. Just follow the trends. I mean, they just continued right on from 2020. And then I did a screenshot just from a few days ago, and it's down to 11%. So you were in the middle of the year at 34%. Now you're down to 11. It's just been getting hammered and hammered and hammered. I mean, yes, the bottom line is right now strategy would still be up and anybody will take a win, but it's been really, really difficult in the past few months for some traders. And this is an isolated example. There are others too. If you want to even go to the next slide, you can talk about that.
Absolutely.
And these are just stuff handpicked by me. As you may know, or anyone who knows a little bit about me, I'm a fully automated trader. But I started in stocks and I follow stocks and I research stocks every day and I'm putting stuff together every day. And here are just some screens that I put together and check out what's happened in the past few months. Mark Minervini is actually had a great year. I think last time I checked, he was winning the U.S. Investing Championship. He's a trend follower, breakout trader. And this was taken from his book, How to Develop Screens, because the key in finding in big returns in stocks, especially, is having stocks that move. So these are high quality scans as I could replicate on high quality stocks on breakouts, just trading breakouts. And this has worked very, very well for not only the last few years, but for decades. You can see on my screen, especially in the left and down in the lower corner, you can see those red lines. Those are simulated trades that would have broken out and then stopped out. And it's stop out, stop out, stop out. And it's all really since September, October. If you look around, there's a couple of cyan lines, which are winning trades. And there was a big one on Tesla, which has since come back and stopped out, but would have been a really nice winner. But all these little just research projects I've put together, it's been stop out after stop out after stop out. And it's been really hard going if you're trading breakouts and trying to follow trends in the past few months. So there's where I get the fascinating word. You're flying high until about May, and then you really hit the fall. And it's just been really crazy. So yeah, pretty fascinating stuff in the stock market. And as I think you hinted with Laurent, I think we're got some weird stuff coming up. I think we got some choppiness coming, or maybe even just a big downtrend. But that's another topic.
Yeah. And I think the comment I was going to share was Laurent said, as soon as you start thinking you're a genius, that's when you're about to be taught a lesson. Not in those exact words, but yeah.
I think we talked about it last time. I tend not to believe any trading axioms, and I don't like to have advice, and I don't like truisms. I like to find out for myself. And you know what's weird is that phrase seems like there are two, and the other side of that coin. When you think you're a genius, you just get hammered. And when you think all is lost, it turns around. Yeah. And I know that we have biases, and I know that we're flawed, we're humans, whatever, but wow, does it seem like that happens all the time? I mean, all the time. You have the thought in your head, man, I got this, and you just don't. It's crazy.
Yeah. So how about we talk about some more things that you've learned in 2021, because I know you've got some excellent examples in the slides. Sure. So number one.
It's late at night. I don't want to get worked up. I'm going to get angry. I put a slide up, and this just happened. This was just a few days ago. I believe it's a 4-hour chart, and it's a Forex chart on the pound yen, which is my favorite Forex instrument to trade. And this just happened. And if you can't see it, or if you're listening to it, it is a bunch of green bars. So a bunch of positive bars, like big body candlestick bars, just bar after bar after bar, and then one little down, and then even bigger bars. And if you looked at the volume, I didn't have the volume in the slide, but if you looked at the volume is huge. And so it's volume, ready for a breakout. And then immediately, huge volume, huge red bars, exactly the opposite direction, and not little bars, massive bars. And I'm just, Andrew, if you're trying to put together a podcast, right, and your philosophy was, I'm going to put out 5 episodes a day for 3 days and then nothing for the next 6 months, like, how well would you do, right? That to me is a V. It's like, listen, it's breaking out. Look I just saw on news. I'm going to put 100 lots on this. This is going to be a massive run. And an hour later, whoa, I got to get out. I want 200 lots down. Like, you should have your keyboard taken away from you and possibly locked up for 6 months. I mean, it's crazy. What kind of relation? What if you had a partner that's, I love you, you're the best, I want to be with you forever, and an hour later is like your clothes are burning on the lawn. Like, who wants a V in their life? Seriously.
What do you mean, what if?
It's horrible, and I hate them, and I'm mad at anyone who makes V's happen, and I'm bitter because I did lose on this trade. So, but there have been a lot of those, and to me, that's a signal of, man, we got some stuff going on. We've got the Fed doing this, and we've got traders worried about inflation, and we've got now Omicron is, what's going to happen, and supply, there's just a lot going on, and that makes V's. The rational, calm trading side of me, I understand that market does change direction,
Yeah.
But this V is outrageous, and I want him to stop. So I'm going to protest.
Outrageous V sounds like a rapper, doesn't it?
Oh, outrageous V. He's my new favorite, I think. I'll buy that album. So yeah, I learned that. There's been a lot of those in 2021. Not a fan. So moving on.
Okay. All right. Number 2.
I think did you have Kevin Davey on earlier, right?
Yeah, Kevin was on earlier. Yep.
One of my personal favorites. I think anyone pay attention to everything Kevin says. I think he's phenomenal. And he actually did not too long ago, if you're a fan of Kevin, he did an incredible study on exits. And Kevin's been fond of saying in his books and otherwise, if you read his stuff, that stop and reverse exits over time, over many instruments, produce the most profit of any other exit. And it was just unbelievable research that he put together, shared it for free. I mean, Kevin's a great guy. From what I know of him. I don't know him well, but I'm a fan. I'm a fan. But stop and reverse, at least in the land of Forex this year, hasn't worked super great all the time. And you would think that's something that works long term. And do I need to explain stop and reverse? If I do, it's the exact opposite conditions. So you get long because your indicators say something, and then you go short only when the indicators say the other one. For example, you go long when it's overbought, and you go short. You don't do anything else until it goes oversold. Well, plenty of examples, but I have automated strategies that stop and reverse. It's like when the conditions set up in the other direction, it stops what it's doing and then enters the other direction. And it works for a reason, right? I mean, when should you get out of a trade? Well, when every reason you have to be in the trade has been exactly flipped, right? I mean,
Yeah.
It makes sense logically. It makes sense on the millions of tests that Kevin. It makes sense in all the tests that I've run. Long-term stop and reverse. Look into it if you haven't. It's unbelievably robust over decades and millions of trades. But you just saw that V in our last slide. Well, guess how stop and reverse would do on something like that? It has not done great. And I have a robot that I introduced in January of this year, back in the beginning, and it wasn't stop and reverse. It's called Master Trend because it's a trend following robot. And that one just gets in a trade, and when it stops, or when it hits its target. It's just one way. It's a one-way street. And it's been choppy because 2021's been choppy, but it's done actually quite good. And it hasn't been nearly as psychologically frustrating to trade. And that was a big revelation to me, to find that one-way trading, when you have a lot going on in a market and a lot of news events, a little bit better in many cases than stop and reverse. And that was kind of a shock to me.
Yeah. Okay. That sounds good. So that's point number 2.
Yeah.
We'll keep moving on here.
Okay.
Number 3.
I tend to like big stop losses. I don't like to get nickel and dimed. It's not just about the trading. It's about your psychology. No trading strategy works if you quit. And I think that's very, very underplayed. I think a lot of people talk about trading psychology, but no one talks about what that really means. And the biggest trader psychology is, can you trade it tomorrow? And the tennis analogy I use, because I was and still am a little bit a high performance tennis pro teacher. But I know with my students, if they lost, no matter how heartbreaking the loss, I was so ready to get back on the court with them next week or their next lesson. I mean, I just couldn't wait. At no point in my coaching career have I ever had a student take a loss and like, well, this job sucks. I'm going to go do something else. Yeah. I mean, it's like, I'm very, very excited to come back and fix it. Trading has to be that way. And people get into trading for multitude of reasons. But if you don't want to come back to the charts the next day after a loss, then you're not in the right business. Either don't ever look at it or seriously do something else because it's going to be a struggle. It's going to be super hard. Well, that's a long way of saying small stop losses do that for me a little bit. Yep. You know, a 20-point stop or a 30-point stop, you know, your win percentage gets down to 10 to 15%. Yes, it's great to get a win, but it's just psychologically defeating. But I have made many versions of my breakout robot. It's called the Dragonfly, but it's a breakout robot. And, you know, I've been testing this for over 2 years. And of course, I test it many different ways: big stop, half stop. And guess what? In an environment like 2021, where things are switching on a dime, where people are acting crazy, big green bar up, big red bar down in an hour apart, smaller stops have worked across the board. I mean, not a little bit better, but way better.
Mm-hmm.
So it makes you wonder if it handles this environment, as long as your small stop losses also make money in a hard trending environment, like parts of 2020 were, where it's just go, go, go. I mean, that's been a big deal for me, to maybe take a little lower win percentage. I am trading live both versions, the bigger stop loss version and the smaller stop, and I'm perfectly fine with both. But the smaller stop version has been, I mean, just way, way better. And that's kind of new to me. To do it in real time, you learn something different, and that's been new to me.
Yeah.
As you can see on the screen, the numerical, again, you know, the disclaimer up front, these are just testing numbers, not from my real account, but it's similar to my real account percentage-wise. The Dragonfly that has a big stop has had a couple of reversals lately, and it's down for the year if you're hypothetically trading one lot. And you can tell the, you know, minus 3,900 as compared to the smaller stop. And it's not small, it's just half as big as the first one. You have, it goes from negative 3,900 to plus 11,000, and it's basically the same strategy. I mean, that to me is very indicative of how crazy this year has been trading wise. I mean, that's a almost $15,000 difference with almost exactly the same strategy. And then I have another version of the Dragonfly, which is even smaller stop. It's even almost half again. And even that one's up, not as well, but it's up. So the performance of the small stop versus the big stop this year has been really eye-opening, and that's something I'm going to carry over into next year.
Yeah, that really shows the power of exits, right? If the strategy is the same and the stop's different, then it can have such a huge difference in the results.
Yeah, when the V's happen, guess what? If the stop is smaller, you don't get hurt as much. So, I mean, it all makes sense. But again, you have to go through it in live markets to see it, and that's been a big one for me.
Yeah. So you think you wouldn't have noticed this if you weren't watching it in the live markets?
I mean, it's one thing I run so many tests. You know, it's something I do for fun. I definitely would have noticed it for sure, but I don't know. I guess it would have had an impact, but also when you turn on your computer in the morning and you look at stop out, and you look at the amount of the stop out, and you compare the two when you lose, to me it's been a psychological big deal. Numerically, probably yes, I would have been able to see either one, and you know, to see it clearly and say, well, yeah, clearly small stop, but psychologically it's been quite an eye-opener.
Yeah. Okay. So I like this one here, this point number 4.
This is very much of how I coach. People say, you know, how do I play? Well, do what you like. You know, if you like forehands, Andrew, hit your forehand. And you'd be surprised that 9 out of 10 people who play tennis don't do what they like. In sports and coaching, I feel like I'm pretty good at that. I got that down. And in trading, I thought I got that down, and I don't think I've got it down yet. I spent time in 2021 trading currency pairs that I don't particularly like. I feel like I have an excuse. I want to blame it on someone else because that's a healthy way to be mentally tough. Just kidding. But I trade the euro yen, for example, and I don't like it. It doesn't perform like the pound yen. I don't like the way it trades. But in America, I can't trade 3 pound yen charts, which is what I truly want to do. I mean, I would have a lot more money if I could only trade the pound yen. Well, the answer is just screaming, right? We'll only trade the pound yen, right? You can just, in America, you can divide it out and you can make multiple accounts. But, you know, I've been persistent, like diversification. It's been pounded into me. You know, I've been wronged early on in my trading career. You know, I believed other people, and diversification is the way to go. And I traded the euro yen. The euro yen is just all year long. And across the board, every single live account I have, and I trade several, all of them would have been better without anything but the pound yen. So, Andrew, give me some advice. What should I be doing? I mean, do what you like, right? I like the pound yen, even when it loses. I like it. I mean, so anyway, I've traded the euro dollar and the euro yen this year. I'm not sure why. The euro dollar version and the different strategy has been fine. It's been about break even, but do what you like. I think I'm fine with this diversification nonsense. It's not nonsense. I get it, but for me, I like to focus. And that just goes with what else is on the slide. The euro yen doesn't trend as well. I'm a trend trader. Those are my automated strategies. Why am I trading something that doesn't trend that great? You have two dinners that you can eat, and I'm going to eat the one I don't like as much. I mean, it doesn't make sense at any level. So, but I think of one thing I did learn though is that the pound yen has been twitchy, but the others, the non-trenders, have been twitchier. The ones that aren't as strong historically in your back test or whatever, those are the ones that tend to go awry. Your trending one, yes, it's going to have ups and downs, but it's the others that have gone really, really cuckoo this year as far as drawdowns and losing streaks that you don't see often or at all. So again, just trade what you like. So that was a tough one for me. I've got it.
That's a good point. I like that one. Okay, let's go to the next one.
This one, I run a lot of tests, and I run a free newsletter, and I try to give away a bunch of ideas. I want to try to help people if I can, blah, blah, blah. But one thing that goes completely by the wayside, and living through the trades every day like we do in 2021 in the twisty environment, I think something is completely lost about how, even if it goes well, how hard it is. I mean, it's not easy. It's simple, but it's not easy. Just stay the course. It's simple, but it's not easy. And this is just a graph of a strategy. And if I came to you and if I was selling you, I was putting on my sales pitch for you, and I'd say this strategy's up, $7,000 trading one lot, on a $20,000 account, you're up 30% for the year. But look at this chart. For 9 months, this profitable strategy that you would want to sell was underwater for 9 months. And then it caught some crazy trends. This was an example of the craziness of the past 3 months being a good thing. And now, it's been a great year. But this was 9 months of misery, right? And then a few months of glory. And I think that is not recognized. I feel like I'm getting better at it. But it's something that we all need to think about and think about often, is that even if it ends up okay, there's going to be toughness and tough times along the way. We need to be ready for that. I think 2021 has shown us that.
Yeah. I think as well, when you're doing back tests and you're looking at 10 years of data and it's all kind of, 10 years of report performance and it's all squashed down and it looks like a nice curve, you don't see these, these periods of pain in there, do they? They're just little blips. But when you're trading it, it's a different experience.
And that's the thing, though. Like, if you have 9 months underwater, who quits in that 9 months? Like, this is a really profitable strategy if you made it till today. But for 9 months, I mean, who would quit? Like, a lot of people might quit. And how many traders do we lose because it just was 9 weird months? They didn't stick to it. So it's just a really, really, you got to be in it for the long term. Yep,
well said. Speaking of being in it for the long term, point number 6, old strategies do very well.
Well, this one actually was a shocker, and I just researched this in the past 2-3 weeks or so. I keep around strategies from years and years ago, 5, 6, 7 years ago. I started making trading robots in 2012, and I pretty much kept anything that I found interesting. And these are just 2 strategies I brought with me tonight. This is a 3 moving average cross strategy. I mean, like, who hasn't heard of a 3 moving average cross? It's really complicated. I'll explain it. We'll be here another hour. When one average is above the other average, you go long. And when one's below, you go short.
Yeah.
And it's just been phenomenal. This little strategy that I've just been sitting in my archive. It's been fantastic trading one lot. It's $5,800 of hypothetical money trading just one lot. And how could this 3 moving average strategy have been ready for the Fed and Omicron? I mean, like, there's no way it could have been optimized for it. It couldn't have known. Now, I could have optimized it by hand. I'm just telling you, I didn't. I dug this one up from years ago settings. But that freaked me out. And a turtle strategy, you know, a lot of people say that the turtle strategies from the 80s, 1980s don't work anymore. And so I built one. This was probably 5 years ago, maybe. And I just let it sit there and I don't bother with it. You know, if I like something else better, then I trade that. And I looked at this. This is just a simple breakout strategy. This strategy, I built this robot probably 6 years ago, and these settings that we're looking at are probably at least 3 years old. So I haven't touched them. And it's up huge this year. Like, who would have known these old decrepit strategies in this crazy V-making year? That really shocked me. And it just showed me the power of fundamentals. Like, we're always, okay, we got to adapt. But man, good fundamentals adapt to a lot of stuff. So I was really shocked by this.
So what do you mean by fundamentals there?
Good point, because I shouldn't say that. And fundamentals in tennis means, right, hitting the ball in and using good strokes. Fundamentals in trading doesn't mean fundamental. I mean timeless principles is a better way to put that. Sorry. Okay. Yeah, using principles that have been around a long time, that have produced profit for a long time. Yeah, not actual fundamental trading. Yes.
Yeah.
Sorry about that.
It's okay. Now, this is the one I've been wanting to ask you about. New book.
Hey, yeah. It's a few weeks old. This is about my favorite fund I've ever found in all my research. It was on a podcast. It was on a trend following podcast, Michael Covell podcast a while ago. And it's a pure trend following fund. Just one guy, one earnest, hardworking guy. And the story of his fund is just amazing. And so I heard that, I did the research, I heard the podcast, did the research, I said, I got to write a book on this. So it's about that, also about losing, because that dovetails into the story. And I might get into a bunch of temper tantrums and what a horrible loser. I might be the worst loser as a junior tennis player of all time. But it's about losing, how to handle it, and how this fun, through some hard times. So it's just a giveaway, a couple of free trading strategies in it. So it's just something I felt like I had to write. I just couldn't believe the story, and I wanted to talk about losing. So there you go. It's out there.
Yeah. Well done on the book. I've got a copy actually, and I'm reading it. It's only quite short. I'm about 3/4 of the way through.
Yeah, it's a couple hours read. Yeah, I don't like long books anymore. Do you? Anyway.
No.
Who
has the time for that? So why do you think it's important to study that kind of thing though? Why do you study?
Well, this particular story.
Yeah.
Well, I mean, I don't want to give it away, but the fact that
don't give it away.
The fact that what this fund went through, and then what happened after what it went through. I mean, I've just, it gave me tingles. I don't know if it would affect me. I'm really into this stuff, obviously, but we all go through hard times. Like, what success really has to do with, and what you might go through, and I mean, it's incredible. So anyway, read the story. You can just look up Purple Valley too. You don't have to read my book. Look up Purple Valley Capital. It's a real thing. You can track their performance online. It's for free. It's public. He didn't want to be interviewed for the book, but I wrote the story anyway. So
yeah, and I disagree with you there. I think you do have to buy the book because you got some commentary that explains things. So I recommend people go and buy the book.
All right, there you go.
There you go. So we're almost out of time, which is surprising. I thought we were going to take longer. So, you've given us some good insights into what you've discovered in the last year. What are you planning to do, or what are you doing to plan for next year?
A lot of it was given away. I'm going to trade what I like. I think it's going to be hard for me to trade anything else going into next year. That's one. And I've done a ton of research and written about it. Trade size. I'm going very deep into the Kelly criterion, which has been around forever, but it was a formula created by geniuses. The guy who created the Kelly criterion is generally considered smarter than Einstein. No joke. Like Claude Shannon. I mean, the guy is amazing, and he wanted to come up with an optimal bet size. And this information has been sitting out for decades, just sitting out there. And I mean, I never studied it. And you have to bet bigger without going crazy. And my trade size via studying Kelly is way, way up next year. So that's the other big thing. I'm ready. I'm a believer. It's pretty amazing stuff.
Okay. Well, you'll have to let me know how you go with that.
Okay.
I've heard mixed results, but we'll see.
Really?
I don't want to
On
get.
Philly,
Yeah.
Okay.
Yeah. All right. Well, thanks for your time today, Scott. Now, if people want to get in touch with you or learn more from you, where can they go? I just realized you've got a slide here. Very clever. I can put this on the screen.
Well, I mean, you go to scottwellstrategies.com.
Yeah.
Go to contact. That's an email with my name with only one T. It's got other things on there too. Facebook. You can go Scott Welsh Strategies. You can go Twitter. You can go YouTube. Look at all those. There's too many places.
You're
There should be
everywhere.
less places to reach me.
Yeah, you're everywhere. And
That's
also,
right.
if you want to hear more from Scott, we did a podcast episode a while ago, didn't we? I don't have the number
We
off the
did.
top of my head, but yeah, people can go back and watch that one. That was a great chat as well. So yeah, thanks for your time today, Scott. Any closing thoughts to finish off this special episode? You're the last one,
really
so no
happy.
pressure, but it has to be insightful.
It's always a pleasure spending time with you. Here's one. I'll just finish with this.
Sure.
Five Guys burgers are really good, Andrew.
Oh, don't tell
like
me
that.
we don't have one here in Australia.
I know, that's why
I haven't
said
had
that.
one for years because we can't travel interstate. It was like my highlight in the States. Five Guys and Red Lobster. Oh my God. Oh, I'm in heaven. If I could have those two every day, and every now and then an Arby's, maybe.
Well, all three of those are within a bike ride of where I live, so I mean, we can end on that.
And it's lunchtime here as well. You are really.
Yeah,
killing me.
see?
Anyway,
There you go. How's that for insightful?
thank you. You're never coming on this show again now.
Oh, I'm done. All right. Goodbye, everybody.
No, well, thank you very much, Scott. We really do appreciate your time today and all the effort you've done putting those slides together and sharing your insights have been very valuable. We're getting a lot of good feedback in the chat as well. So thanks to everyone for attending today. We've got some good questions over the three guests. So if you enjoyed the show today, I'm sure you did because it's been awesome. Give us a thumbs up for the video and hit subscribe and make sure you get notified of any new content. And that's it. The year is almost officially over. We still got Christmas. So I wish everyone a happy Christmas and a great holiday season. And let's get ready for a big 2022. I had to think about the year. How bad is that?
No,
It goes so quick. It's like, what year is it? So thank you, everyone. All the best. Thanks, Scott. Cheers. All right,
Bye.
cheers. I haven't even got the outro lined up. I'm just all over the shop. So thanks again. Cheers, everyone. Bye.
Bye.